well know, many businesses have been impacted, many employees have been impacted, and we seem to be getting daily guidance. Not that it really matters to you guys, but I used to get an email, 2 or 3 emails a day with updated changes in the law, and now I'm averaging 11 to 15. So it's a lot to learn, a lot to absorb, and a lot to work with, particularly if you're an employer and you have employees that are stressed out. So what I'm going to do is give an overview of some of the recent legislation passed, explain how it impacts employers, and the practical ways to manage your employee workforce. By way of background, my area of expertise is ERISA, employee benefits, and tax provisions affecting employers. As a result of that, I get into FMLA issues, COBRA issues, etc. If you have any questions, please enter them into the chat box, or you can email me directly. I can't promise I'll be able to answer every question, but those that I'm unable to answer, I will get back to you by email if you want to shoot me an email. What we're going to talk about is primarily the Families First Coronavirus Response Act and the Coronavirus Aid, Relief, and Economic Security Act. FFCRA is what I use when talking about the Coronavirus Response Act, and the CARES Act is what I use when talking about the legislation under the CARES Act. So the Families First Coronavirus Response Act takes effect April 1, 2020. This is the real first large piece of legislation that came about as a result of the coronavirus epidemic. And what it is intended to do is provide paid emergency sick leave and expanded family and medical leave to employees working with employers, and those employers have to have fewer than 500 employees. What it's intended to do is to provide leave payments to those who are unable to work as a result of the pandemic. Bear with me a second. The payments are made to the employees during the leave period, and the employer making the payment gets tax credits for the sick leave payments made to employees, and there are also tax credits for the health coverage maintenance. There are a few exceptions from the FFCRA. The small business exception applies to those with fewer than 50 employees who are generally exempt from the family and sick leave requirements related to school closing or child care unavailability, when those requirements would jeopardize the viability of the business as a going concern. That's a pretty heightened standard. So those of you who have fewer than 50 employees really need to consider whether or not you're eligible for this exemption. Healthcare providers may also be exempt from the FFCRA for obvious reasons. We need the healthcare providers to work during this pandemic. Moving on to kind of go into a little bit of detail about the paid sick leave and the paid family leave, how it's calculated. The emergency paid sick leave applies if an employee is unable to work or telework because they're subject to a quarantine order or advised to quarantine, if they're taking care of a relative under quarantine, the school is closed for public health emergency, or other circumstances provided by the Department of Health and Human Services. The paid sick leave applies to 10 paid 10 days of paid sick leave benefits, where full-time employees receive 80 hours of paid sick time, and part-time employees receive a prorated payment. Essentially, if we're talking about the paid sick leave, if we're dealing with the employee's own illness or quarantine, they're paid at the regular daily pay rate up to a cap of $511 per day. If we're talking about sick leave to take care of a family member or child, then it's 66% of regular daily pay up to a cap of $200. There may be intermittent leave situations, so long as the employer agrees to those certain situations. And this is really, the paid sick leave is really a limited leave program, leave payment program. For example, if an employer is open for business, and this occurs before the shutdown, employer's open for business and furloughs an employee, that employee is not entitled to the paid sick leave. Now, keep in mind, we're going to go through the CARES Act, and we're going to talk about unemployment compensation benefits and other entitlements that kick in if an employee is furloughed or if an employer shuts down. But that's not what the FFCRA is intended to do. The FFCRA is intended to assist those employees that need to take a leave of absence because they've been directly impacted by coronavirus or because a family member has been. Now, after the paid sick leave, we've got the paid family leave, which provides 12 weeks of leave for employees who can't work because their child is unable to or go to school or because the child's child care service is closed. It applies to any employee who's been on the payroll for at least 30 days, and it can be used intermittently, so long as the employer agrees. The employee can use the emergency paid sick leave that for the first 2 weeks. Otherwise, they may substitute other available leave available. They may substitute other available leave. For the remaining 10 weeks, keep in mind this is 12 weeks of leave. First 2 weeks, usually emergency paid sick leave can be used or available leave substituted. The remaining 10 weeks of leave benefit is paid at 66% of regular earnings, up to a cap of $200 a day or $10,000 total. There's a varying hour calculation for part-time employees. So if you're trying to figure out what your employees are entitled to, if you're already a part of the shutdown, chances are you may not have very much to deal with under the FFCRA. If your employees are not coming to work, they're furloughed, you're shut down, then we look to the unemployment compensation rules and the CARES Act to assist in that regard. Now, before we move on, I wanted to talk about some of the questions that we've been getting from our clients, particularly as it relates to leave, layoffs and furloughs, and individuals who are subject to a 2-week quarantine because they are showing coronavirus symptoms, et cetera. A lot of the questions we get have been, well, we've got these employees that are going to be laid off, or we've got these employees that aren't working, they need a leave of absence. What happens with their health benefits? There are a number of things employers can do to assist in this during this time. We've got COBRA obligations. If you're under the FFCRA, then you have to keep coverage intact during the leave period of time. The there are going to be changes to employer-sponsored group health plans as a result of COVID-19 or the coronavirus. We have expanded protections for coronavirus testing and treatment. That has become one of the essential benefits that a group health plan must provide without cost sharing or deductible. We've got amendments to health savings accounts that may be applicable. So any employer operating an employer-sponsored health plan is going to be impacted one way or another by the legislation and by the acts created as a result of the coronavirus. Now, one of the other questions we get is, okay, well, we've got all this sick leave that we're paying under the FFCRA, how are we going to manage those payments? For some clients, it's been a pretty heavy burden. One of the ways the government has decided to help is by giving a tax credit to employers, typically equal to 10 days of the qualified sick leave wages paid, 10 weeks of the qualified family leave wages paid, plus any qualified health plan expenses. The tax credit is taken against Medicare, Social Security, and all income tax payments the employer would otherwise have to pay. One of the interesting aspects of this provision, or these tax credits, if the total amount of the credit calculated by adding sick leave wages and family leave wages and health care plan expenses exceeds the tax liability, that excess is refundable to the employer. And one of the things that I'll mention, and I'll mention again towards the end, is that the CARES Act added an amendment to the FCRA that provides for advanced refunding of the tax credit. So essentially, employers are permitted to apply for an advance of the tax credit they should be receiving or should apply to their income tax obligation. The CARES Act also provides for a waiver of penalties for failure to make deposits of related employer payroll taxes if it's determined that that failure was due to the anticipation of this employer tax credit. It's extremely challenging to evaluate the FFCRA and keep it separate and apart from the CARES Act, particularly when advising employers. But it's important to understand what each act is intended to do and how it's intended to assist employers. One of the questions we've been getting is, if an employee has COVID symptoms and needs to take a leave of absence or is subject to a quarantine, but has already used some of their FMLA leave, how are they impacted? And generally, the employee is entitled to the paid sick leave, regardless of how much FMLA leave they have taken. The paid sick leave, again, is 10 days, usually for weekly based payrolls, 5 days a week, work week. If the employer was covered by FMLA prior to April 1st, and the employee's eligibility depends on how much leave the employee's already taken, then any expanded FMLA leave taken would count against the employee's entitlement to the general FMLA. And I realize that's confusing. The expanded FMLA is provided under the FFCRA, under the new act and the new guidance. FMLA leave, when I use that term, is the leave that's been in existence for quite some time. So let's do an example. If an employee was eligible for FMLA leave and took 2 weeks in February of 2020, before the FFCRA came about, that employee would still have 10 weeks of FMLA leave and or extended FMLA leave under the FFCRA. Before I move on to the CARES Act, I also wanted to mention that employers that are sponsoring what we call Section 125 or cafeteria plans, health savings accounts, flexible spending accounts, all those plans have been impacted by the FFCRA and the CARES Act legislation. There are some permissible requirements and there are some automatic changes to those plans. As I mentioned before, you need to make sure that, one, if you're offering a group health plan, that plan does provide for COVID-related treatment, COVID-related testing, without cost sharing and without deductible to the employees. It's also important to note that employees are not going to, there's not going to be any impact on the definition of a high deductible health plan, simply because that plan provides first dollar coverage for COVID-related expenses. So my recommendation for employers sponsoring group health plans or health benefit plans is to talk to their broker, talk to their advisor, talk to their counselor, make sure that the plan is providing the required benefits related to COVID, and ensure that any amendment to that plan that's made as a result of COVID, follows ERISA's requirements for plan amendments and transmission of a summary of those amendments to participants. Now we'll talk about the CARES Act. The CARES Act was the second enormous piece of legislation enacted. It followed the FFCRA, and it's intended to provide unemployment compensation type benefits and other expanded benefits and credits for employers to help manage their workforce during the pandemic. As mentioned before, the CARES Act is really intended to provide unemployment compensation benefits to employees who are unable to work as a result of COVID-19. This is a little bit more expansive than the FFCRA. It covers individuals whose employment has been affected because they're diagnosed with COVID-19, or a person of their household has been diagnosed or showing symptoms of COVID-19, or they're unable to reach the place of employment because a quarantine has been imposed. The unemployment assistance, the unemployment assistance lasts 39 weeks, ending in December 31st, 2020, and the benefit equals the amount of the state weekly benefit plus a federal pandemic unemployment compensation amount, generally $600 weekly. So the CARES Act provides enhanced unemployment compensation. The states can enter into agreements with the Department of Labor and provide enhanced unemployment compensation benefits to individuals who have exhausted and are not entitled to receiving state regular unemployment compensation, or those who are able to work, available to work, and actively seeking work. There's also, as part of the CARES Act, there are also provisions that provide for payroll tax delays and employee retention credit, where there's a payroll tax credit equal to 50% of the qualified wages paid during the period the employee is not providing services due to COVID-19. The retention credit is really to incentivize employers to keep employees on their staff and paid, even though they may not be providing the same level of services that they were pre-shutdown or before the quarantine. Well, I think one of the challenges that a number of our clients have had to deal with is communicating the Act's provisions to their employees, explaining exactly what the employees are entitled to under varying circumstances. You know, as we've heard, there's also a stipend or a payment to individuals coming directly from the IRS that's supposed to help with the financial burdens created as a result of this pandemic. The communication of the Act's benefits and requirements, as well as the regulations and the authoritative guidance issued as a result, makes it a challenge for employers and HR professionals to communicate to employees what they're entitled to, or when they might receive certain pay, sick leave wages, or other type of stipends from the government. Our recommendation is, if possible, if you still have the ability to communicate with employees, have your benefits brokers, have your advisors, have your counselors do kind of an alert every week or so, updating with changes, with new guidance, new issues that directly impact employees. Obviously, you don't want to overwhelm employees and give them every single change, but if there is additional guidance issued regarding unemployment comp benefits under the CARES Act, it would be nice just to provide that update to employees, just so they know that you're aware and you're on top of things, and that also gives them some assurances. We can't ignore the fact that this pandemic has created an enormously stressful situation, not just for employers, but for employees as well. And the more accurate communication given, the better off everyone will be. And as somebody who uses social media on a regular basis, I can tell you that about 50% of the information I'm reading online, whether it's Facebook, Twitter, etc., is incorrect. And I think that's creating a lot of issues for individuals and a lot of misinterpretation of the acts that have been passed. As employers, there's no obligation to give employees all the information, but it certainly is helpful and it certainly is advisable at this time. One thing that a lot of our clients have been interested in is the Paycheck Protection Program. Now, the Paycheck Protection Program is intended to be a loan for eligible businesses for payroll obligations, emergency grants, and to cover immediate operating costs. Essentially, the loan is made to assist with these payroll and small business expenses, and it can be a forgivable loan. So long as the amounts are used properly and used as expected, in some cases, in most cases, the loan will be forgiven. Now, there are various regulations and various requirements that apply, and my understanding is that there was a certain amount bookmarked for these payroll protection programs, and many of those amounts have already been committed. So if you as an employer intended to apply for the payroll protection program and have not yet, you may not be able to get the first wave of funds bookmarked for this program. We do understand that they intend that there is likely to be additional funds granted under the program, but as of yet, I've not heard anything definitive. My recommendation, if you have not applied and you were planning to, continue to gather the information needed to apply and continue to get your applications in if possible. You'll be put in a queue, and hopefully if and when the next round of funds are released for the program, you can qualify. I mentioned earlier the $1,200, they're called recovery rebates under the CARES Act. There is a phase out depending on an individual's adjusted gross income or household's adjusted gross income. But it's intended to assist individuals with the economic realities of this pandemic. I know of several that have already received the direct deposit of the $1,200, and I know others are waiting and hoping to receive theirs shortly. I mentioned earlier a retention credit, an employee retention credit, which is a payroll tax credit equal to 50% of the wages paid, 50% of the wages paid by employers whose operations were partially or fully suspended due to COVID-19 shutdown order, or whose gross receipts declined by more than 50% when compared to the same quarter in the prior year. The credit is provided for wages paid and eligible costs incurred March 13th through December 31st, 2020, and it's generally limited to $10,000 of eligible wages per employee. Again, this is a provision that's intended to assist employers and hopefully incentivize them to keep their businesses up and running and their employees retained, even though business and receipts have declined. One of the interesting things that the CARES Act did was provide opportunities for employers to assist employees who may be struggling financially. Part of the Act provides for expanded loan 401k and retirement plan loans, or 401k and retirement plan in-service distributions or hardship withdrawals. These are permitted provisions. So now, if an employer amends its plan to provide or permit, participants can receive coronavirus-related distributions equal to the lesser of $100,000 or the employee's vested account balance. Employees can repay that distribution, and the distribution won't be subject to the 10% penalty tax. However, it's important to note that the distribution will be subject to regular income taxes. Similar to the in-service distribution rules, the expanded plan loan rules permit an increased plan loan from the limit used to be $50,000, or the amount of the employee's vested account balance. Now that amount is increased to $100,000. And there are loan payment delays for individuals who already have a plan loan. They can delay the plan loan payments for 1 year without impacting the 5-year maximum loan term. While I've summarized these pretty succinctly in the slide, there's a few points I'd like to make. First, employers are not obligated to offer expanded retirement benefits. Expanded hardship distributions or plan loans. In order to do so, there are certain requirements that must be made. For example, a coronavirus-related distribution is a distribution based upon the employee's certification that the funds are needed to assist with the employee or spouse or dependent being diagnosed with COVID-19, or because the employee experiences an adverse financial consequence as a result of COVID-19. Obviously, employers are not going to want to chase after their employees and review all their financial records. In this case, the Department of Labor has permitted an employee certification. So if you as an employer are going to amend the plan, your retirement plans, to permit these expanded loans or hardship distributions, make sure you're getting the appropriate certifications to ensure that those distributions are being made for the purpose intended. And you will have met your plan sponsor fiduciary obligations related to those distributions. Those employers that sponsor the old-fashioned pension plan, defined benefit plan, money purchase pension plan, are required to make minimum contributions every year to the extent the actuaries determine that a minimum contribution is required, and it's based on the plan's funding status. These contributions due in 2020 are now due January 1st, 2021, which gives employers a little bit more time to make the contribution. One thing to note is that interest will apply to any pension plan contributions that are delayed through January 1, 2021. Required minimum distributions are waived for 2020, which can impact your 403B, 401k plans, profit sharing, other defined contribution plans. It's important to note that certain partial plan termination issues can arise if you've got a substantial reduction in plan participation. If half of your workforce is furloughed, laid off, or, let's say laid off, then you've got to evaluate the impact on your pension plan or your retirement plan to determine whether the accelerated vesting provisions that apply to partial plan termination applies. These are fairly complicated issues to consider, but hopefully, rather than going through each element that may not even apply to everybody listening, hopefully it triggers a red flag. If you note that half of your workforce has now been terminated or laid off as a result, think about your retirement plans and what the implications are for those plans. One of the questions we've been getting from clients, particularly those that have a pension defined benefit plan, or safe harbor 401k plan, is, in these times, are we able to reduce or not make the safe harbor contribution, or reduce the pension contribution or the accrued benefit? What can we do to save costs with respect to our retirement plans. Those questions require a review of the plan documents, the vesting provisions, the contribution types, what kind of notices have been made to employees about the plan itself. And it's something that must be done considering all of the laws that apply to retirement plans. So you can't just say, well, we're supposed to do a 3% match for the entire year of 2020. We're not going to do that anymore. Well, if everything you have out there and given to participants says that they're entitled to a 3% match for compensation earned during the plan year, you have to be very, very careful before you reduce any match or any accrued benefit. I'm not saying it can't be done, but you are limited as an employer in how you can implement some of these changes to your plan. Also want to mention, if I haven't mentioned before, that the hardship loan provisions, RMD provisions, any kind of change in accrued benefits will likely require a plan amendment. And there are very strict rules that apply regarding when plan amendments can be signed, must be signed, when they can be effective. And there is, in most cases, a notice requirement to participants notifying them of the changes to the retirement plan. The CARES Act also offers to employers the ability to provide up to $5,250 per employee in tax-free payment of student loan obligations. This provision falls under Code Section 127, and there are various non-discrimination rules that apply to these student loan payment obligations. This is also a very limited provision. It really is intended to apply through the end of 2020. It is not that I've heard anyway, it's not intended to be a permanent expansion of the educational assistance reimbursement rules. But it is one way employers can help their employees, particularly those who have student loan repayment obligations. I can tell you that a lot of the student loan providers that we've worked with and that we are working with have automatically stopped student loan repayments or put them into forbearance. So they're essentially making the decision to stop collecting student loan payments during this period of time. Of course, individuals can contact the loan provider and request that they be obligated to continue making payments, but it is something that we've seen a lot of the student loan providers doing to provide assistance to individuals with student loan repayment obligations. Well, this expansion of the educational assistance program gives employers a chance to help as well. I had mentioned earlier that the health plan coverage, provisions of the FFCRA requires that commercial health plans, including employer-sponsored plans, self-insured plans, cover diagnostic testing for COVID-19. It will cover treatment of COVID-19 without deductible or other cost sharing requirements. And one of the expansions includes a telehealth service expansion. It used to be that only certain specific medical services can be provided via telehealth, and those rules have been relaxed substantially to assist with a lot of the shutdowns and the quarantine issues. As I mentioned before, you've got to consider what your plan document provides, what has been communicated to employees regarding group health plan benefits, and any changes will likely require an amendment to the plan and a communication of that amendment to employees. I'll mention this briefly, but I don't want to go into a lot of great detail because it's fairly complicated. But if you're an employer covered by the Affordable Care Act, otherwise known as Obamacare, and you use the look-back measurement period for purposes of evaluating an employee's status as full-time versus part-time, you really need to be careful, particularly when dealing with employee termination or layoff issues, because the use of that look-back measurement period methodology will likely require extension of full-time status beyond the date of termination or beyond the date upon which hours are reduced or layoff occurs. So just keep that in mind. If you're using this look-back measurement period under the Affordable Care Act, you've got very unique issues to identify in determining when healthcare coverage terminates or when somebody loses healthcare coverage due to a layoff or a furlough. Unsurprisingly, the Act, the FFCRA, and the CARES Act all touch on or bring into play the COBRA continuation coverage requirements. This is a question we get fairly frequently. You know, if my employee has been subject to layoff, but we're not terminating them, what are our COBRA obligations? Well, if you're an employer with 20 or more employees, you are subject to the federal COBRA rules. There's a PA Mini COBRA Act that applies to employers with 2 employees up to 19 employees. You know, COBRA applies if there's a loss of coverage due to a termination of hours or a reduction of hours. Those are the 2 elements we look at to determine whether or not COBRA applies. In which case, you've got a COBRA notice obligation. If you lay somebody off and their coverage under the health plan is affected, there's likely a COBRA notice obligation. Employers have asked us if COBRA applies, can they subsidize the employee's cost of that coverage? And the response is generally yes. But one of the things that I want to caution you about is making sure you're speaking to your health insurance provider and letting them know what you're doing, letting them know that you want to keep these individuals covered under the plan on the same terms and conditions, even though under the policy terms they would have lost coverage otherwise. Most insurers will be fine with that, but you just want to make sure you cover your bases and you've got their okay to provide expanded coverage. If you've got a self-insured plan and you're offering to subsidize coverage costs, keep in mind that certain strict non-discrimination rules apply. So if you've got a self-insured plan, you shouldn't be paying for the executive staff's continued coverage, but not the rank and file employees. You're going to have a discrimination issue if you do so. We haven't had a ton of questions on this, but I want to note that there's an often overlooked code section that allows employers to make payments or gifts to employees during certain qualified disaster time periods. Code section 139 allows an employer to give employees payments to assist with a qualified disaster, and that payment is fully deductible by the employer, and it's non-taxable to the employee. However, as you can imagine, very, very strict rules apply to the payments and the purpose of those payments. But it's another thing employers can do if they've got an employee who's struggling or a group of employees that are struggling. I mentioned earlier that the CARES Act made some technical changes to the FFCRA, and that is the case with respect to the compensation caps under the FFCRA. The last thing I'll mention is that those employers who are obtaining some of the loans, the payroll under the Payroll Protection Program, are going to be subject to caps on executive compensation. So it's important, if you are taking advantage of any of the loan programs under the CARES Act, that you evaluate your executives and their compensation to make sure that they're not in violation of those loan covenants and that they're not in violation of the executive compensation rules. At this point, I've covered quite a great deal of information. I'd like to offer the ability for participants to ask questions, and I'm going to try to do this the right way. I think I have to stop sharing my screen. I've looked at the Q&A, I've looked at the chat box, and it doesn't look like we have any questions. You will note that my contact information is provided at the end of the presentation. My email address and the phone number provided is my cell number. Again, I realize that we've gone through a great deal of information. It was very broad and technical. Any questions that you have that I didn't answer, I'm happy to answer. Just give me a call or shoot me an email. Mention that you attended the seminar and you had a question. I'm happy to answer it for you. Kristen, I'm not seeing any questions.
I don't see any either, but I do just want to say thank you to Sarah for presenting on that information. I know that there is a lot out there, and I appreciate you clarifying all of that for us. If anyone does have any questions, please feel free to include them in the Q&A box down at the bottom. We'll leave it open for about a minute or two more just to see if there are any coming through. If there aren't, like Sarah said, you can reach out to her directly with her email that's on the screen after this. If something comes up that you think of that you might have thought of afterwards, feel free to reach out.
And Kristen, will you be circulating a copy of the PowerPoint?
I can do that, yes. If you send that to me, okay. I will be sending out an email probably Monday morning with the recording and also the PowerPoint as well for the attendees. And then we'll be posting that on our website as well. So anyone can get that information. Thank you. Okay, I don't see anything coming through, so I think we'll end it here. And then, like we said, if you have any questions, please feel free to email Sarah or reach out to the chamber and we can connect you. And again, thank you, Sarah.
Sure, no problem. Happy to help. Take care, everyone.
You too. Have a great day.